look at it, you could say, I want to solve the expected wealth. I want to maximize the logarithm of wealth at a time t. Turns out there's this fraction that's very simple, right, that you can define, and you could apply this to Bitcoin, and you'll get a number that says, based on the past behavior of Bitcoin. So let's say you're going at the 70%, because you have to estimate what the long-term rate of growth of Bitcoin is. Well, let's say you say it's 70%. Well, if you buy it at 70% and it doubles, well, now you're going to be more like at 85% in a year. Or you're too high. So now you have to sell 15% of your position and reduce that. So now you have cash. And then maybe next time around it goes down. Well, if you rebalance a year later, now you're going to have less than 70% because your Bitcoin is worth less. So now you're only at 60%. So you have to go buy back. So Kelly is sort of a buy low, sell high kind of model. Now you could say, well, okay, how does that work with Bitcoin? Can you get more Bitcoin with this way? You can't actually get more Bitcoin, but you can reduce the volatility quite a bit. In the end, you're going to have a little less Bitcoin than you would have if you didn't do Kelly, but you'll have a lot less volatility. So it's really a question, again, of a personal thing. How much volatility can you stand? And a lot of that depends on the size of your stack, how old you are, whether you have a job, whether you have other sources of income, et cetera.